Hey there, Mike Wise, CMG Home Loans with your weekly mortgage update. The last few weeks have seen a little bit of rough road for the interest rates. They've gone up a little bit here, but between the stronger job numbers, inflation ticking up slightly, and bond yields rising across the globe, we've seen mortgage rates, they've inched up a little bit. But it's not all bad news. Inventory is growing, which means more choices and more negotiating power for buyers. And in this video, I'm going to break down kind of what's happening in the market, some encouraging trends in inflation data, and a new bill that Congress could completely change how capital gains are taxed when you sell your home. So let's dive in to what that all means for you. So let's take a look at this here. All right, this is the, in fact, let's start off with this here. So this is our weekly update. Here's no sales tax on homes. So at the end of the day, there's a bill out there. I'm not quite sure that it's going to get over the finish line here and happen, but it would eliminate tax capital gains on the sale of your primary residence when you sell your house. So that's some good news there on that as well. CPI moved in the wrong direction the last week here. So it accelerated to 2.7% from 2.4%. A little bit of an increase there. And the core went to 2.9% from 2.8%. So not a huge impact on the market at this point in time. The producer price index, however, was a little bit better than expected. So that was down at 0.2% month over month, pretty flat. In fact, it was flat, so it did not go up. I'm not going to go over this, but builder confidence went a little bit higher, which means it's still on the low side, but it went a little bit higher. But we do have a problem with inventory and building new homes with the amount of people that are out there. So at the end of the day, the bond market, they're looking at the BLS report, stronger than expected. Falling unemployment rate went from 4.2% down to 4.1%. But at the end of the day, this is kind of the rates, they came down just a little bit towards the end of the week here. And before I go into that, let's take a look at the Fed, kind of what the Fed watch is looking like for, this is what that's looking like from the Fed page here, as far as what the Fed is going to do with interest rates at their July meeting. So July meeting, 95% chance that they're not going to do anything whatsoever. I disagree with this, but there's a 95% chance that they're going to do nothing. In September, there's a 57% chance that they're going to drop by 0.25%. You have a couple of people out here that they're going to drop 50 basis points. And some that are out here that are going to stay pat and not going to lower the Fed funds rate. So that's September. October, same thing. It's kind of sticking right around that 4 to 4.25%, but more people are moving towards lower rates here. So I'm going to go into that in detail later here and show you a little bit of what's going on. So interest rates, 30-year fixed rate, 6.82%. It was down just slightly from yesterday. The yields are starting to come down a little bit. This is a $750,000 loan, $4,900 for your principal and interest payment there on those things. So just a look at the bond market, and let's take a look at the prices. This is the prices. So the higher the price, the lower the interest rates are concerned. So these are mortgage-backed securities and the prices. And you can see over the last couple of weeks here, we've seen the prices go down. And that means that interest rates are actually going up. So today, what we saw is a little bit of a reversal. So you can see that line. It's kind of the tops of all of those days of where the bond market ended up as prices. Today, we actually ended up, or we've started to go a little bit higher. So that is good news. That means that right here, this is kind of going past the 100-day moving average. So we went clear over the, we're kind of sitting on the 100-day moving average, but you might see those go up and kind of pass through here. So there's some support, and I'm not going to go into details, but this is the crossover here. that is showing support that interest rates are going to fall a little bit further next week. Now that's just kind of the technical side of the trade, and there's not much coming out next week as far as data is concerned that's going to move the market very much. So it's all going to be technical trading. Same thing you can see here with the yield, and so the yield, if the yield goes up, interest rates go up. So this is the exact opposite of the prices, where the price is going down, then the yield is going up, or the rates are going up. Here we saw, we kind of go to the bottom, we draw a line there, all the bottoms of all of those daily closings, and today we crossed over and we're kind of sitting in between two different levels here, the 440 level, which is kind of these, and the 450. So we're kind of sitting in that camp right there. If we do see it break down below, you may see it kind of drop down a little bit lower and get back down to the 420 level. And I think that there's a good chance of that happening, but probably not next week here. So what I did want to go over was a little bit of there's a lot of talk about the Fed Chairman Powell and his resignation. And so, or trying, is he going to get fired? Is he going to resign? What is he going to do? So let me show you a little bit of kind of why the data kind of supports that Powell really should lower the Fed funds rate. So let's go into this a little bit further here. So I'm going to stay on this page for just a tad bit of time here. So this is when the Fed actually cut interest rates. September, November, and December last year. They cut it 25 basis points, 25 basis points, and 50 basis points. And up here, you're going to see the current levels. So the current levels of the unemployment, and inflation numbers, right? Personal consumption expenditure, and the core, and the CPI and the CPI core numbers. So the unemployment rate is currently at 4.1%. It just went down last month. We think that that's going to change a little bit just because of all the kind of the numbers that are coming out and changes. And we think that'll go up just slightly a little bit. But the Fed cut when it was at 4.2%. They cut it when it was at 4.1%. The Fed cut it at 4.2%. So they went down by 100 basis points at the end of last year, September, November, and December, when all of those things we're at 4.1% today. Why not drop it even further? The personal consumption expenditure. This is the Fed's favorite measure of inflation. It was at 2.5, it was at 2.1, and it was at 2.3%. So in November, yes, it was at 2.1%, and it went up slightly after that. But at the end of the day, we're at 2.3%. Now the Fed, they cut at all those levels there. Same thing, the core is at 2.7. They cut it at 2.7, 2.7, and 2.8%. CPI, Consumer Price Index, another favorite of the Fed's inflation numbers. We're at 2.4% today, and they cut at 2.5%, 2.4%, and 2.8%. Same thing on the core. The core inflation is way better. So the Fed has always been looking in the rear view mirror at data, and now what they're coming out with is they want to wait and see as far as what the impact is on the tariffs and how the tariffs has an impact on the inflation. It's the first time they're looking forward. I think the Fed Chairman Powell is nervous about being the only chairman to have inflation go up twice in his term, which I don't think is going to happen. So now, labor market. They're also saying that the labor market is very, very strong. This is ADP. ADP added 56,000 jobs over the past 3 months. So you can see MBS Highway is reporting through ADP here. The job creations shows significant declines. It's going down. We are not in a 100% strong labor market at this point in time. Now, this is the continuing claims. So this is people that have gone on unemployment and now have been sitting there and they cannot get a job. So they keep on trying to get a job, but they cannot get a job. So the continuing claims that need unemployment further or longer is going up. So you can see it's approaching 2 million rapidly, very, very quickly here. And so this is a kind of another item here that shows that the Fed should lower the Fed funds rate. Now, the core PCE, this is the inflation numbers. This is the favorite measure of the Fed. So 11, this is a little blurry here for you, but 11 out of the past 13 months, it's been well below 0.3%, which is well below the Fed estimates. And you can see that this is kind of January, February, kind of outliers here, and now it's coming back down. Yes, it's trending up just a tad bit, but not much at all. So the inflation seems to be under control. Now, I'm going to talk about this for just a hot second. This is the relationship between the Fed funds rate and the 30-year fixed rates. So normally the Fed funds rate and the mortgage rates, they track pretty closely. So you can see, when they drop the Fed funds rates, the rates do drop eventually here. But there's over here on the last part. So this is when the Fed dropped 1% over the last September, November, and December of last year. And you can see the rates, the 30-year mortgage rates actually went up. What that's telling me is that the bond market does not agree with what the Fed is doing. They don't have the confidence in the Fed as to what they're doing. And past performance has kind of shown what they can what they haven't done soon enough. So I don't think that they're reacting soon enough to the market. I think that there's room. The real rate of kind of the real rate that it should be at is around 3% here. We need to start getting down to that 3% level. That's another 1 to 1.5% lower in the Fed funds rate. And so I do think that we need to start getting there because the lag effect of the Fed making these changes does have an impact. So couple of things real quickly here, and I'm not going to go into this. If you haven't seen this interview with Kevin Warsh, it was a very, very good interview. He is a potential replacement for Chairman Powell, whose term is up in May. But he's getting a lot of pressure over the last month here to resign, or there's always news that President Trump is going to fire him. He's not going to fire him, I don't think. But at the end of the day, he's getting a lot of heat to resign if he doesn't lower these rates. But Kevin Warsh, he talked about the call for a regime change at the Fed, and he goes into a lot of details about that as to why. This continuing with the independence between the Fed and the executive branch, and then where interest rates cuts and balance sheet moves should take place in order to get the rates lower, which would have an impact on the mortgage rates over time, and it would kind of shrink the difference between kind of the Fed funds rate. So the difference between the Fed funds rate and the mortgage rates would shrink a little bit. So that would go down and be a little bit different there. So this was a great interview. You should go out and watch it and listen to him. I think that he would be a great change for the Fed governor or Fed chairman position. And then yesterday, the Fed Governor Waller, again, he is definitely on the side of the rate cuts. So what I showed you earlier about kind of where the Fed's kind of plot is to lower interest rates, he is on the camp of lowering the interest rates. And his reasons are outlined here. Tariffs, he thinks, is a one-time event as long as your long-term inflation expectations are well anchored, and we think that they are well anchored, right? And then basically data is showing that we should be neutral. The neutral is that 3% rate. It is not the 4.25% to 4.5% that we're at right now. Again, I'm not going to go into detail on this. And then the BLS reports basically, they're half of them are from the state and local governments. Basically, all the revisions that have taken place. The payroll growth is stalling, all those things, which is, again, him saying here that they're 1.25% to 1.5% above the neutral rate where they should be. So A lot of stuff here. I know this is a little bit on the geek side of things, but it does give you some information as to, I do think that the mortgage rates are going to start to drop here. It's just a matter of time. And if Chairman Powell resigns, it will be very interesting, and I think that you will start to see the bond market have more confidence in whoever the new Fed chairman is, that the interest rates will be lower, and you'll start to see the bond market cooperate with that and go to lower interest rates. So this is Mike Wise. I will be around all weekend. If you have any questions, please feel free to reach out to me. I know this is on the long side, but it was a good time to go over this with you. Thanks a lot. Have a great weekend.